Welcome to the Tech Exits Podcast. In today's Investors Corner, we take a deep dive into where tech investors are putting their money, exploring market trends, founder challenges, and what it really takes to navigate the complex world of tech M&A. Today, we have the pleasure of welcoming Brian Mac Mahon, founder and managing partner at Expert Dojo. Expert Dojo is an early-stage global investment fund that has backed more than 300 startups across the U.S., Latin America, Africa, India, and other emerging markets, with a strong focus on helping founders scale through execution and customer-driven growth. Let's begin. Thanks, Brian, for joining us.
My pleasure. It's great to be here. Looking forward to it.
So, to start off, can you tell us a bit about Expert Dojo, your investment thesis, and what stage and sectors do you focus on?
Sure. So we launched around 10 years ago as a growth hacking firm, as a growth hacking agency, and we're all growth hackers. So some of us are branders, other people are personal branders, other people are outbound, all across the board, but we're very, very good at marketing. And about 5 or 6 years ago, we decided that we would start making investments into companies. And rather than relying on fees, we would make the investments. If the investments went well, we would get a really good return on the investments. And we've been doing that for the last 5, 6 years. We've invested in around 300 companies over the world. We've invested in Latin America, we've invested in India, invested in Africa, invested in the US. Our thesis is very simple. We believe that the money is in the bridges rather than the land masses. So it's about Mexico or Latin into the US or into Europe and into Spain, India, across to Dubai or into the United States, Africa, around the world, maybe into China. And that's really where the true value is. So we make very early stage investments into companies, put small checks of maybe $50,000, $100,000 in. If the company is growing with our help very quickly, then we put a further $1 million in. And then if we really, really, really like them, then we really get to work and put some proper money into it later on.
Excellent. Thank you. And, well, from your VC perspective, what's driving the search?
I don't know. If you ask, look, it's cool. Like, I like statistics. They're nice. And numbers are nice. But the real truth is you have to speak to people with money and say, how much more money do you have from venture capital this year than last year? And I'm pretty sure every limited partner you speak to in all of America is going to tell you less. Exits are like down big time from like major IPO exits. And I know that because the thing is with the numbers, you can make the numbers sound. And even the investments that are going into startups, like, yes, if you look at one main number, it will say that the amount being invested in is a lot, but yeah, that's like $10 billion into thinking labs, or how many $1 billion or tens of billions of dollars into OpenAI. This is not going to like Jimmy or Pedro or Sergey, who are getting like $500,000 into their early stage seed startup. I would argue two things. One, this is the most challenging and difficult landscape in venture since 2006, 2007. It is brutal out there for anybody going through. It's also the most exciting time because there are better companies and better founders, and it's easier to get rid of the clutter. Also, a lot of companies that probably shouldn't have been companies in the first place, those companies don't exist because they don't last to where they are right now, which is better for the great companies because they don't have all this noise and things going on around them. So look, but it's a very, very, very difficult time. And by the way, there is one extra positive, is that even though the middle class has shrunk to nothing, both in the United States, probably in Mexico and other places as well, the ultra rich people, there's more people that are ultra rich, and there's more people that maybe didn't have money before that are breaking through. So I think there's more access, but it's more difficult to convince investors that they should put money in. And I think it's going to be a really, really difficult rest of 25, 26, and 27 will start to get better. And I think 28 will be an incredible year.
On the same topic, how does this environment compare to previous exit waves that you've seen?
So, but by the way, the environment is compounded by the fact it's not just the venture space. It's also real estate. Like real estate interest rates are like 5, 6, 7, 8. The banks got murdered a couple of years ago when Silicon Valley Bank got destroyed. And so now all of those banks are really afraid. And so they don't leverage anything. They're not even leveraging against real estate. I'm seeing some banks leveraging 30% on real estate. Now they used to leverage 70%. So what does that mean? It means all of those property developers who previously used to be LPs. So like I said, I haven't seen a time like this since 2006, 2007, where we've had real estate getting massacred. And then inside real estate as a subsection, like the office space, who goes to an office anymore? So COVID destroyed all investment in offices. And you can't just turn an office into a residential building tomorrow. Like it's a monster job to try and do that. So you have like huge disruption in real estate, which means liquidity is not coming through. Huge disruption in venture. I heard a podcast from Jason Calacanis the other day and they're not him, but the people he had on the podcast were later stage. And they're now talking about 10 to 15 year funds, not 8 to 12 or 5 to 8, 10 to 15 year funds. What LP wants to wait 10 to 15 years to get their money back? So like, I've never been in an environment like this. And it's not to your point on qualitative. It's not simple enough to say, oh, it's bad or, oh, it's good. Like there are just multiple aspects of it, which means that VC needs to change. Anyone who's a venture, firstly, everybody and their mom, dad, and sister is a venture capitalist today. Like people literally finish college and they're like, what do you want to do? It's like, oh, I think I'm going to be a venture capitalist. And it's like, well, where are you going to get money? Well, I'm just going to raise the money. And the problem is that there's enough people out there where that sounds kind of cool and sexy that people are raising like $2 million funds and $3 million funds, which are a total waste of time because they can't live on a $3 million fund waiting 15 years to get their money back in the future. But now you've got all of these funds out there, all deploying money. They're not sure where to deploy the money to. You've got all of these founders here who are in an environment where there's not a lot of liquidity around, so people aren't buying things, but that means that the best founders are taking through. You have a lot of noise around artificial intelligence, where if it doesn't say artificial intelligence, nobody wants to invest. And why is that? Because all investors are idiots, right? And once they hear a buzzword, everybody's like, that's the greatest thing. They don't even know what artificial intelligence is, but they're like, we can only invest in there because investors are sheep and they follow other investors. So I find this a really good time, but it's very, very, very nuanced. And you have to be hyper aware, whether you're a startup in this space or whether you're an investor in this space. You need to be hyper aware of everything that's happening so that you mold your offering to something that's going to make you unique.
Very interesting. And well, we know that you help companies with more than raising money, right? Let's say that if a company on your portfolio is looking for an exit, how do you help them get prepared, and what's Expert Dojo's role in that process?
So it's evolved over the years. I think I've gotten nicer, even though it seems like I've got less nice, right? And because now what I do to founders, I've always believed that venture capital is a type of pyramid scheme. If you know what I mean by that, like it's a fake environment whereby people think that they're doing stuff to achieve an outcome, but in reality, you've got some 12-year-old analyst in San Francisco who's worked out an algorithm which just tells them how much money that Andreessen or Sequoia or somebody else should put into a company. And they worked out because like, and this isn't about those companies, by the way, there's no baddies or goodies here. It's just a messed up system. But like back in the maybe 10 years ago, a Series A would have been $3 million. And that's okay. Because if one company gets $3 million and another company doesn't get $3 million, that company that doesn't get $3 million, it's not so unfair that they can't fight against this company and still win through if they have a better product. The problem today is when you give OpenAI or any one of those other companies that are emerging, like $3 billion on the first day, like what are you telling companies? You're telling great companies breaking through that the customer doesn't matter. And you're telling very, very inefficient, terrible founders that they can spend as much money as they want on whatever they want to spend it on, and they're going to be successful. And the terrible truth is they probably will be, because it doesn't matter. It was like with WeWork. It was exactly the same. A perfectly amazing company was destroyed And I would argue a great founder. I didn't like him myself, but I think as a founder, he was a great founder. But the company was destroyed because they just got given so much money that they didn't have to act as a company anymore. So yeah, I just think it's a look, we've always focused on growth. We've always focused on the customer. I've always said that if you build great customer love and your customers think that you're amazing because what you provide is amazing, then you're going to win, right? It might take you a little bit longer, but then investors are going to see you and then it becomes a self-fulfilling prophecy. Back in the day, I would just say to people, go and do it and you'll be fine. And we'll introduce lots of people from our side that will help you. We know the messaging will improve your margins. We know that your voice and how loud your voice is will increase your margins. We know that like your outbound will increase, all that stuff would be good. These days, I rank every single company against every other company. I build future IRR scores, or we call them adjusted IRR scores. And then we literally rank them beside each other. And then I'm like, you don't have a name anymore. Your new name is number 37. And if you're number 37, then why would anybody want to invest in you? Like, be number 21. That's cool. People will want to invest in 21. But if you're 126, nobody wants to invest in 126. So we really build in behaviors that get people very focused on growth with their customers. That's it.
Based on your experience in your portfolio companies, are you seeing more exits happening through strategic M&A, IPOs, or secondaries right now?
Like I said, I think it'll come. Look, but the secondaries has become very hot, but that's because it's really bad. It's not hot because everybody woke up this morning and said, "Oh my God, you know what we should do? We should do secondaries." It's hot because there's no IPOs, right? And so when there's no IPOs, it's the only option you have is to try and get money from wherever it can come from. But the problem with secondaries is a discounted marketplace. So if I'm buying a stock in, SpaceX, obviously, well, I'll use SpaceX as an example. Like if there is secondaries, which I'm sure there is on SpaceX, you're buying it at a discount. Sorry, they're selling it at a discounted price because they have to get in secondary unless it's very hot. But if you're actually probably SpaceX is a bad example because I think Trump doesn't hate Elon anymore, so they're probably okay. But like if it was a Series C company that's breaking through and somebody has stock and the company's valued at $1 billion, then they're selling that stock at 700 million or 600 million. So you only sell on secondaries when your LPs are pushing really hard for liquidity, as what's happening right now in the market.
That's very interesting. I recall hearing from other entrepreneurs that have solid multiple companies saying that in their first exit, they had decided to do it themselves and accepted the first offer that came to them, only to learn afterwards that perhaps they should have proceeded differently.
Yeah, and I think look, the bigger point there is it's good to have an expert around you. Look, I've known plenty of people, they've accepted the first offer, it's being an amazing offer. I've known other people that have got over the price, and I've got other people who've got under the price. Like it's in many cases, it's just a case of like where you were and the timing and everything else. But no matter what, like I think if you're gonna do legal work, you should have an attorney check it. Like you'd be silly. If you're gonna do an M&A, you should have an M&A specialist check what you're doing. You'd be silly not to. It's just common sense. Like the intricacies of like how and where and when, like there's so many variables around that. But just you got to surround yourself with expertise. Like you're not buying M&Ms, in your local corner shop. You're talking about multiple hundreds of millions of dollars. It's like it's big time.
Thinking back to a recent exit you were involved in, was there something that caught your eye about how founders think or how buyers behave?
So we started investing 6 years ago, really, and then we made a few investments in the first year and a few investments in the second year, and then we went really hard in year three, which was like 3 years ago. So we're about halfway through our life cycle on the fund. Our expectation is the exits so far. Our exits, honestly, I would rather not have had because they're too small because it's too early in the fund. We've tracked out the next 3 years, and we believe that with about 10 very carefully chosen companies that we have, that we're looking at probably a 4 to a 5x on our fund within the next 3 years. And we should still have about 130, 120 companies in our portfolio for the future. But we're very, very, very focused. Like everything I say to you is what I'm focused on and what other VCs should be focused on. This game we're playing is not a game for 5 years, 10 years, or 15 years. It's for 2027 and 2028. And anybody who's not playing that game is in the wrong business. So ask me this question in 2028. And if we have, done at least a 3x, then we've done great as a fund. If we haven't done a 3x, then we shouldn't be raising a second fund.
There are always challenges when aligning perspectives. So how do you navigate misalignment between founders and VCs on exit timing or valuation? How do you handle those situations when they come up?
I don't know about misalignment. I read all these posts. I kind of have to stop myself because I'm very direct. Like, I'm Irish, first of all, which doesn't help. And then I lived in Mexico and La Condesa for a little while. So that doesn't help either. So, so I have both of those things. But I read these posts from founders saying, you should try and find a good VC that should support you. I'm like, what the hell is wrong with you people? Like, are you stupid? Like, you're a founder. You're there to run a business. A VC is to give you money. You take money, you take that money, you manage it properly, and you return more money. Like, that's your job. Your job is not to make friends. Your job is not to go painting rainbows in the park or to have picnics or anything like that. You don't care if they're nice to you or not nice to you. Like, build a great company. That's your job. And VCs by the opposite end of the spectrum, like this old game of, well, we invest in 20 companies and we just want one to make it. Yeah, that's because you're an idiot. Like, you need to make sure that you focus on supporting founders to grow. Are you going to get bad returns? So no, there's no misalignment. VCs don't work for founders. Like, as far as VCs don't care about founders, VCs shouldn't care about founders. VCs should care about their LPs. That's who they work for. That's who they return money to. Founders shouldn't care about VCs. VCs are a function of what they will receive if they don't have a shit product. Like, that's it. That's the game. And so just build a great product, build a great product with your customer, make sure you got a good social media team, dropping lots of reasons why you're the best founder in the world to invest in based on your growth, not on your hype. And then folks will invest in you. It might be VCs, there might be family offices, there might be other people. It's not complicated. It's not a love story. It is just investing. That's it. If a founder sets a valuation that people feel is a good valuation to buy in at, they'll buy in. And if they set a valuation which is too expensive, they won't buy in. If they set a valuation that's too cheap, then too many people will buy in and they got the wrong advice from the wrong people. Like, there's no alignment. There's just like the great thing about a founder. Look, whether you're a founder of a sweet shop, let's do venture capital ventures. Whether you're a founder of like a highly scalable technology business out of Mexico City, which we have a great founder. Actually, I'll give you a few examples of some good Mexican founders that we have. But like, whether you're a founder there or whether you're a founder of a fund like me, right? It doesn't matter. We have the same objectives. Build a great company, differentiate yourself, make sure that you are always priced in a way that people are going to get good value from investing in you in the future. And then don't lie to the people who invest in you and do exactly what you said you're going to do. Like, that's the oath. If there's an oath, that's the oath. There's no friends. There's no anything. Afterwards, sure, you do what you want to do. But beforehand, there's no dinners, there's no lunches, there's no coffees. There's just like, sell your product to customers and make sure that people buy from it. And like I said, I've got some great companies like eBombo, fantastic company out of Mexico. Mateo, we took Mateo in the very early days. And Mateo's done an incredible job on building the company up. I think Mateo will hit like $1 million a month within the next like 2-3 years. And Mateo did it his way. Venture capitalists all told him to do something different. And he focused on the customer and on the growth. And based on the customer and the growth, he's at like 400 or 500K a month right now. And he's stone cold killer. He's done great. I've also invested in companies in Mexico, people who thought they had something. Like, I won't give names because it's not fair, even though I want to. But like, one is like an influencer. Oh my God, she thought she was the greatest person in the whole world. And you know what I'm going to do? It's going to change everything. And no, you can't execute. Like, go and execute a great product with a customer, and then you're going to get great returns from that. And then another company, which was an amazing entrepreneur, and he tried really hard, and he wanted to build a healthcare system which was really going to supplement the lack of really good healthcare for the general public in Mexico. And I liked that because it was really big and it was bold and it was difficult. And even though he didn't make it, it's fair because he was trying something so hard, but he was honest all of the way through. We have another great company, which is a booking platform. And even though they're not technically 100% out of Mexico, they are a lot, called We Book You. And We Book You are brilliant. And they built like this amazing fintech software inside a travel software. I would, again, bet money that company will hit $1 million a month in revenue. And they're doing great. And then we put money into another company, which is a company that focuses on universities and tries to teach the teachers what they want to do. So again, another wonderful founder, and she's like working her ass off and trying to break through in the ed tech system, which is really hard to break through on, but at least she's honest about it. That's all I ever ask for me or for anyone. Just be honest about what you're doing. Don't hype people. Don't lie to people. Don't lie to yourself. And then go out there and work every single day to build customers, not to build investors.
Thanks, Brian. Earlier, you spoke about AI and mentioned a few other sectors. As you know, markets are always evolving and changing. So which sectors or technologies are you most excited about right now, and why?
Every VC who only focuses on AI is an idiot, right? Every company only has to do one thing. They have to grow at 200% every single year on average. Now they can get away with 100% or 50. Like, it's a very simple process. You don't have to build a unicorn, but you definitely have to build $100 million company to be in any way venture attractive, right? And so to do that, let's say 100 to 200% growth. Your first year or so, you get to 10 grand a month. Then you grow at 200%. That's 30,000 a month. Then you grow, let's say 100%, that gets you to 60,000 a month. Then you grow at like 200%, that gets you to like 180,000 a month. Then you grow at 100%, that gets you to 360. And then you go, let's say 200%, that's 360s or 18. What is that, like 1,080,000 or something? And so you get to 1,080,000 a month in 4 years. Like, that's the model, or 5 years. Now, sometimes a company might say, well, Brian, it took me 2 years to get the product fit. That's perfect. Your stopwatch will start when you get that product fit, that lovable product fit. And then you start building up to that $1 million a month. Any company that is not planning for that trajectory should not be raising money, period. Build a great company. It's a service company. It's a lifestyle company. God bless you. You'll probably make loads of money. You'll have great holidays. You'll do great, but you are not for an institutional investor in venture-backable startups. So that's all you got to do. Some people will have loads of AI. Some people don't need AI. Some people will build marketplaces, which will be able to get like manual workers and physical workers, and they'll have thousands of people. Like, a great example of a company that became a unicorn was the Blair Staff guys, who built out Nacho, who built that as a recruitment company out of, I think he was out of Chile, or was he out of Argentina? I can't remember. But he built that from zero to a $4 billion company in whatever amount of years, raising zero money. So look, AI is very cool, very awesome right now. Everybody loves saying AI. Every VC feels they're clever when they say AI. But at the end of the day, the only thing that matters, market size is big enough, company can grow at 200% growth, founder has the ability to execute, has the team to be able to fill the gaps that will actually take you to that level. And you can get to that $1 million a month in revenue as quickly as possible, so you can raise a monster Series A and have a shot at the title. That's it. If you have AI, killer. It'll probably get you there quicker. If you don't have AI, but you build faster with customers, I'll invest with that one first.
To wrap up, what advice would you give to founders that are looking to elevate their growth or exit strategy?
Don't listen to me. Don't listen to me. Look, founding a company is a very personal experience. VCs don't know anything. Nobody does. I don't know it. They don't know it. Nobody else knows it. Like, we all just like do stuff and then have opinions on things. Only a founder knows. What I can say is that, like, for anybody who hasn't gone on the journey yet, it's a tough, long, lonesome, difficult, hard journey that will push you to the edge. And the founders who generally make it are the ones they kind of embrace that edge. I don't want to glamorize it because there's no glamour to it, but like, they're the founders who just don't care. They don't care about family. They don't care about friends. They don't care about lifestyle. They don't care about health. They don't care about marriage, kids, anything. Like, they're prepared to go to the edge. Now, that doesn't mean that they don't love, but they don't, in that moment, they have done a contract with themselves or whoever else that they will put everything else aside and risk insanity to get to that place. And founders a lot of the times don't really ask themselves if they are that person. It takes a very messed up person to go all the way, like really messed up. And so not everybody is that person. Like, some people really embrace that and they love it, but most people don't. So yeah, just know who you are and then position yourself in a place where you surround yourself with people that can actually levitate you to that area rather than a bunch of people who just tell you how great you are.
Brian, thank you so much for chatting with us and for your insights. I'm sure that your outstanding experience and perspectives will inspire and will be of great help to our listeners.
My pleasure, always.
Thank you for joining us today. Are you considering selling your tech company? Head over to quorumgroup.com, our tech exit sponsor. If you'd like to learn more about selling your tech company, join us at one of our Tech M&A Masterclass events. Attendees of the Tech M&A Masterclass will gain practical knowledge on how to achieve the maximum valuation for their company gained through expert-guided workshops, hands-on exercises, and M&A case studies, or online through our virtual conference and webcasts. Head over to wfs.com for more details. We'll see you again for the next episode.